There are three major depreciation methods that are used more frequently. One is called straight line depreciation, or SL. The second is called units of activity, or often units of output, and double declining balance. So these are the three methods we're going to use to calculate depreciation. What you do need to understand right up front on all three is we talked about the three things we need to know. We need to know the cost, the residual value, and the useful life. But no matter which one you use of these, you have to remember the book value. Remember, the book value is the asset cost minus the accumulated depreciation. In either methods, the book value will never drop below the residual value. So we're going to start with straight line method first. This is the easiest one there is because it allows you to have the same depreciation every single year. Remember, depreciation is an expense which increases your expenses, which decreases your net income, which decreases your taxes. So depreciation is basically a non-cash expense. I want to reiterate that. So here's the formula for straight line method. I'll give you a chance to write it down. It's the actual cost minus the residual value divided by the useful life. And this is to calculate annual depreciation. I'll wait while you write this formula down. Or put it on pause while you write it down. Now don't forget, cost minus residual is called the depreciable cost. So the $22,000 is my depreciable cost divided by 5 years, says that every year I'm going to do $4,400. That'll be the same depreciation every single year. And so it'll kind of look like this. So here's my depreciable cost. Every year I'm going to take off $44,000 for expenses. So basically I'm doing it, if I'm doing a 5 years, I'm doing 20% a year. Now the percent is not used in the straight line method as much as it is in the other methods, but it's important to understand the percents. So 5 years would be 20%, because if we think of it as 100% divided by 5, it's going to be 20%. So all you really need to do to understand the rate, the straight line rate is the same every year, is you just need to know how many years the useful life is. So everything is basically 100%. 5 years divided by 100% is 20%. 8 years divided by 100%. I'm sorry, 100% divided by 8 years is 12.5%. So just by knowing the years here will tell you immediately what the percents are. If I was doing 4 years, immediately you know it's 25%. So this is a percent of the straight line. This is how I'm going to calculate the depreciation. Now I will still show you the journal entries here, but keep in mind we learned how to do these in Chapter 3 under adjusting entries. So the focus is not on journal entries, it's on how to calculate the depreciation. So $4,400 a year, here's my year 1 depreciation. Debit the expense, credit the accumulated. It would also be the same journal entry on year 2, 3, 4, and 5, because every year it's exactly the same. Now again, don't forget that we talked about accumulated depreciation is a contra asset account because it's the asset minus the contra asset minus the accumulated depreciation is the book value. And we'll talk about that again right here. So we always want to know what is the book value of the asset. That means what is it worth on your books at any given time. So with straight line method, at the end of the first year, my equipment asset account would have $24,000 minus the $4,400 in my accumulated depreciation would give me a book value of $19,600. Well, at the end of the second year, let me show you what's going to happen. So at the end of the second year, my book value will be $15,200 because it'll be 4,400 times 2 because I'll have 2 years in there minus that would be 8,800 minus the 24,000. So each year my book value will go down until my book value at the end of year 5 equals $2,000, because book value never drops below residual value. Extremely important. Remember that.